Firstly, I'd like to thank the organisers for the opportunity to speak with you today. I'm Fergus Gordon from Accenture. I look after our banking industry for growth markets, and I'm honoured to have this chance to share with you some thoughts and to pose some questions to you all on the topic of financing in the new decade, possibilities, opportunities, and challenges. To get started, the first question I'd like to pose to you is, do you feel the rain? Do you fear the storm? And this question was initially posed 5 years ago by a venture capital fund manager in the US in regards to how banks were responding to the potential rise of fintech. And while I still feel it is just as applicable for banks today as it was then, I think we are now also at a pivot point in the disruption cycle where it's just as applicable for fintechs and neobanks in regards to achieving meaningful profitability in a reasonable amount of time. So let me take you through some of the reasoning for why I believe that's the case. From a traditional bank's perspective, there's no doubt the industry is undergoing severe disruption. In a recent Accenture study, we systematically quantified the level of disruption being experienced across 11 industries. We measured both the current level of disruption being experienced today and the level of future susceptibility to industry disruption for 10,000 companies using 62 indicators and over 12 million data points. You can see the framework we used for this assessment on the right-hand side of this page. And the results from the study for the banking industry told us what we already knew, that our industry is, by and large, in a period of high volatility, where the largest segments, predominantly consumer and commercial banks for diversified and regional banking, are experiencing high levels of current disruption, while also being highly susceptible to additional disruption in the future. And no more evident is that than in Asia, where the wave of neobanks being launched or launching is increasing seemingly by the day. And those segments that aren't experiencing high levels of disruption currently, largely the wealth and investment banking sectors, are likely to experience high disruption in the future. And this tallies to the change in the industry structure that we've seen in the last decade or so. Since 2005, new players make up 17% of the global banking market. Basically, 1 in 5 players are new to the market. And this is being facilitated by supportive regulatory environment and by the democratization of technology. And so now the banking landscape has morphed to consist of 5 main types of players: the traditional banks, our neobanks, our neo payment companies, fintechs, and the big techs, right? But despite this change in landscape, limited revenue has leaked out from the traditional players. Outside of the UK and perhaps China, less than 4.5% of industry revenue has been ceded to fintechs or new players, with most of that revenue leakage being concentrated in the neo-payment space. And with the path to profitability for new players typically being 8 to 12 years, the question becomes, when can the fintechs, the neobanks, and the neo-payment players capture the gold at the end of the fintech rainbow? And when you throw in the vulnerabilities that the pandemic has uncovered for fintechs, and as you can see here from some of the items I've extracted from the World Economic Forum's COVID-19 FinTech Impact Assessment Study for 2020, you can begin to see the pivot point I mentioned at the start. Let's just take a few of those indicators. Under external risk indicators on the right-hand side, you can see that liquidity risk and cybersecurity risk were up 17% year on year in the first half of 2020. While under financial implications, the increase in negative responses in regards to concerns for capital, valuation, and fundraising were severe. Yes, fintechs have become more resilient the longer the pandemic has gone on. Yes, fintech fundraising is back at historic highs, at least through the first half of the year, after falling by 2/3 in 2020. But the question remains, can that pot of gold at the end of the rainbow be captured? And for many, I think it's time to take off the rose-colored glasses and be real about what it takes and what needs to change in order to be successful. We've already had some cautionary tales. We've seen Jack Ma's Ant financial empire be tamed and broken up by the regulatory bodies in Beijing. We've seen Zinja, a neobank in Australia, fail to secure additional capital and have to give up its banking license and return deposits to customers. And we've seen 86400 that promised a smarter way to bank and to take the fight straight to the big four banks of Australia, sell itself to one of those big four. So in this context, I think the question, do you feel the rain? Do you fear the storm? Is just as applicable to the neobanks and the fintech players in the industry as it is to the traditional banks who've been dealing with this disruption for years and quite successfully dealing with it, mind you. So now I'd like to take a change in tack for a moment and take a look at the consumer. What are they thinking? Are they going to help or hinder the dream of our digital and fintech and post-digital future? In 2020, Accenture released its latest incarnation of our Global Financial Services Consumer Survey, where we surveyed 47,000 people across 28 countries to assess what customer trends are now apparent in the market. As part of this work, we've developed 4 personas based on a detailed cluster analysis of how consumers perceive and engage with banks and insurers. The results were quite interesting. But first, let me just introduce you quickly to the personas, those 4 personas that I mentioned. The first persona are the pioneers, right? These are people who are tech savvy and hungry for innovation. They're keen to engage digitally and they like to work with their financial services providers through digital channels. In terms of the makeup, they make up 24% of global consumers, which is up 6% from when we did the survey in 2018. The second group are the pragmatists. They see technology as a means to an end rather than a lifelong passion, and much more pragmatic around how they engage with their banks, how they engage with their financial services providers. They make up 21% of the global consumers, which is actually down 2% from 2018. The third group, which is our largest group, and consists of 38% of the global consumers, are what we call the skeptics, who are tech wary and generally dissatisfied with the services provided by their financial institutions and financial providers. And the final 4th group are traditionalists. The traditionalists value the human touch and avoid technology wherever possible. They make up 16% of the global consumers. But interestingly, this group is down 8% from 2018, which is a big contraction and has shifted across mostly into the pioneers and the skeptics. All right, so with that said, let me share some of the results of the survey. First, and as you can see below, outside of Hong Kong and Japan, Asia Pacific has a much larger set of pioneer consumers who are tech savvy and keen to engage digitally. In Southeast Asia, Indonesia and Thailand have the largest set of pioneer customers, which really sets the stage for this digital future, right? And really offers the promise for digital banking and for the fintech and neobanks to really land with their propositions. But interestingly, and over the last 2 years, usage of digital channels has dramatically increased. If you look at the top 2 segments there, you can see access to the banks via mobile app or website has increased by 10 percentage points, by 18 percentage points in the last 2 years, right? And by 7 or 8% when you think about using the desktop or the laptop. Right? That's a massive increase in just 2 years. And as we correlated this and cross-referenced these statistics, we believe that COVID-19, with all the restrictions that's been in place, the lockdowns, etc., have largely driven this technology take-up, and we believe it's accelerated digital take-up by up to 5 years. The third point around the consumers I'd like to make is around what they value. When we asked what were the top 3 factors that were most important to you when dealing with banks and insurers, value for money came out on top, up 10% from the same time in 2018. But perhaps tellingly, those factors associated with customer experience, which you can see here, all fell, and not by insignificant amounts. And the hypothesis I'd like to pose for you all here today is that with all the investment that has gone into improving the digital customer experience or the general customer experience over the last 5 to 7 years, and the improvements that have been realized in that space, while we believe the customer experience continues to be important, perhaps we are now at a point where further investment in improving the customer experience is undifferentiating for the players in the market today. And finally, the final point from a consumer perspective that I'd like to make is that the trust divide enjoyed by banks over other institutions is quickly eroding. Banks are still more trusted to look after their consumers' long-term financial well-being than any other institution and to look after their data, but that gap is closing, and it's closing not by others catching up, but by banks falling back. So now we're in a position where traditional banks are facing a large set of consumers who are tech savvy, who are eager to engage digitally, and who are seeing improved customer experiences, but valuing it less, and who are losing trust in corporations to look after them and their data, and more so losing trust more so in the banks and the other institutions. So then let's turn. Where does that leave us from a banking industry perspective? What I'd like to posit is that the way forward is a new era of co-opetition. So what does that mean? Well, we are seeing neobank and traditional banking business models converging towards what we're calling a post-digital endgame that is anchored on a digital-first distribution model, technology-enabled personalization, ecosystem across all 3 layers of the customer journey, like marketing, sales and origination, and servicing, and that is anchored on transformed profitability and cost structure powered by more flexible technology and operations. And importantly, this post-digital endgame is about co-opetition or cooperation between fintechs, neobanks, and the traditional banks. For in this post-digital world, co-opetition will create value through rebundled product propositions. To understand this concept of rebundling, we need to understand the evolution of the product proposition. Originally, traditional banks had a fairly standard macro product proposition that you can see there on the left. Let's start with our base products and then cross-sell credit cards, loans, investments, and time deposits or savings products off a base deposit or current account. And then with the advent of fintech and supported by the drive towards open banking, we saw the macro banking products become unbundled or componentized according to the opportunity to drive better customer outcomes and satisfaction. As I said, initially, this unbundling was largely driven by the payments product and driven by the opportunity to cut fat and improve the customer experience in the fee space. However, we've seen more and more of this unbundling occur, and we're now at a point where every single macro product that a traditional bank offers has now been unbundled. And now we're at a point where we're seeing rebundling of these products, these product components through co-opetition between the fintechs, the neobanks, and the traditional banks to create new value for customers with different propositions. Now, to give you some examples, this unbundling isn't just imagined, it's real. Right? Here you can see an example of how the fintechs are unbundling the traditional macro products of a large traditional bank. In this case, Bank of America. But we're seeing this unbundling happen all over the world, and no doubt driven by many of the fintech players and the people who work there at those fintechs in this audience. And a good example of the rebundling approach is the neobank N26 from Europe, which has architected a range of full banking and insurance services by seamlessly stitching together or rebundling services from its ecosystem partners. And by doing so, it is able to deliver on end-to-end customer needs without the same level of capital investment of launching a more traditional vertically integrated bank. More importantly, it doesn't need that integration to grow. What it does need is customer ownership and acquisition that is driven by a differentiated, seamless customer proposition that meets customer needs. And so the question for the community today isn't necessarily how to do this, or for the players today isn't necessarily how to do this, but who to use and how to manage the ecosystem of players. As you can see on this page, from a digital lending perspective, we're in a very crowded field. And choosing the sustainable players to provide the product components that go into your rebundled product propositions will be key. As will being able to effectively manage and maintain the ecosystem of players providing those propositions, providing those product components. We recently surveyed business leaders on their view towards ecosystems. While 84% felt ecosystems will be at the heart of their success moving forward, only 46% of executives said they were actively cultivating ecosystem partners, and less than half felt that they had the skills and the capabilities to be successful in this area. These are telling statistics which traditional banks need to address, and an opportunity where neobanks can exploit. For the traditional players, the key takeaway is, and one of the key implications is really the need to look to simplify procurement and onboarding processes when it comes to fintech players, because the traditional processes and journeys just simply don't work, and they don't work fast enough, and they don't work effectively enough for banks to take the opportunity that the fintechs are offering. But some banks are already exploiting the opportunities driven by rebundling product innovation. We're seeing 4 models here emerge. The first is where components are rebundled internally and distributed through a bank's own channel. For example, here you could look at Santander's auto loans platform in Brazil, or you could look at the Marcus product by Goldman Sachs, where Marcus is leveraging common Goldman Sachs group components like the balance sheet and the license. The second model is where the components are rebundled internally, but also incorporate external components that are again distributed through a bank's own channels. And here you could look at, again, in May 2021, Santander launched a platform that offers customers the ability to receive property appraisals through the entity's mobile app, where the platform incorporates Data Ventures' property appraisal tool and house fire services. Or you could look at, and then the third model you can look to is where internal components are vertically bundled and sold as a service to others to distribute. Right, a couple of examples here: Capital One, Synchrony, or Goldman Sachs providing end-to-end credit card services to non-banking players like Walmart or Apple, or down in Australia, Westpac providing transaction and savings accounts and other cash flow management tools to Afterpay clients. Or closer to home, you can look at Standard Chartered providing banking as a service to e-commerce players through its Nexus venture in Indonesia. And then the fourth and final model is where components are provided to others for incorporation into a third party's value proposition. And examples here again include Goldman and Citi with Stripe Treasury, which is treated as a rebundled product. Stripe also provides its own components, but pulls in those products, those components from Goldman and Citi. Or you can look at Barclays, which provides the FX desk and near real-time quotation services for Currency Cloud working behind Revolut. Regardless of the model chosen, creating customer value through hyper-personalization will be key, as is creating the ability to monetize customer trust and brand promise, which leads to my final point. Digital competency is not enough. Our research shows that outperformance only occurs if the organisation has a strong sense of purpose and architects its customer experiences, its employee propositions and product offering in a trusted, fair and transparent way. Proposition, it needs to be highly purpose-driven. From our study here, you can see that digital leaders with a strong sense of purpose are able to deliver on average ROEs that are almost 50% higher, in this case 12.8% versus 8.5% than the rest of the industry. And the price book valuation is 150% higher. In this case, leaders are 1.9 times book value versus the rest of the industry, which is at 0.7%. So a clear differentiating purpose is important. So to close, as we enter this new decade, we see the future of financing changing dramatically. There are 5 things I'd like to leave you with as takeaways. 1, winners will be those that will be able to manage and execute across multiple business models, and this is likely to lead to new banking structures that enable portfolios of business models to coexist at the same time. 2, we believe traditional banking will continue to shrink over time, but the value created by traditional banks will be delivered through consolidation, efficiency, and by a greater emphasis on purpose. We don't foresee a resurgence of the traditional branch-based banking model. 3, we believe that customer experience, while important, is becoming undifferentiated, and that we foresee the battleground moving back to product, particularly around this concept of rebundled product propositions. 4, a key decision for banks is how to pursue this strategy, either through, by making a choice, there's a decision to be made between either through enabling this through a common platform or by ring-fencing multiple portfolios of businesses. There's a strategic decision. We're not sure where that's going to play out just yet. We're starting to see a shift towards the ring-fencing of portfolios of businesses under new corporate structures. And then 5, and finally, while tech and digital excellence is critical, by and of itself, it's not enough, right? It needs to enable a clear, purpose-driven business strategy that's positioned around the customer and that delivers on a clear customer value proposition. Thank you very much for your time and the opportunity to share my perspectives with you on the future of financing in the new decade, the possibilities, the opportunities, and the challenges. I hope you found it informative and provocative. I've enjoyed the opportunity, and thank you once again to spend time with you. Thank you very much. Goodbye.